Still losing to inflation? Are you utterly exhausted watching your hard-earned savings melt away? If you click away from this video right now, you will lose thousands of dollars to the relentless creep of 2026 inflation and massive Wall Street fees. But today, we are pulling back the curtain on the do-nothing investing strategy. By the end of this video, you will have a fully automated, recession-proof wealth-building machine that generates passive income while you sleep. Meet Sam. He's a busy professional, and like most of us, he is completely paralyzed by the sheer volume of financial jargon out there. Whether you're grinding out a soul-crushing corporate job, answering Slack messages at midnight, or hustling as a burned-out freelancer, you don't have the time to become a Wall Street analyst. Sam is suffering from severe financial burnout. He knows he needs to invest to protect his future, but the overwhelming volume of information causes immediate analysis paralysis. The modern algorithm feeds on his financial anxiety, aggressively targeting him with screaming crypto influencers and flashy 2026 AI trading bot ads promising guaranteed returns.
Let's be brutally honest. If Sam hears the phrase revolutionary AI trading bot one more time, his head will literally explode. He desperately needs to understand the critical difference between active and passive investing. Active investing is the exhausting attempt to beat the stock market by predicting which companies will win and lose. It's stressful, requires constant monitoring, and transaction fees eat your profits alive. Passive investing, on the other hand, is simply matching the market. As legendary investor John Bogle famously said, "Don't look for the needle in the haystack, just buy the haystack." Armed with this logic, Sam finally decides to take action, finally. But exactly as he begins to set up his automated system, a sudden disaster strikes. Sam accidentally clicks a disguised, sponsored link and falls straight into a hidden trap. He lands on a hyper-complex margin trading platform designed strictly for institutional pros. His screen violently flashes with aggressive red margin warnings. His hands shake. His finger slips on the touchscreen. The system freezes, instantly locking his account into a highly leveraged 100-to-1 short position. Did a single misclick just trigger an automated margin call that will wipe out his entire life savings and plunge him into permanent debt?
Crisis averted. He jams the back button and violently closes the browser just in the nick of time, canceling the leveraged trade before it executes. Sam's heart rate slows down. He realizes he needs a passive income investing guide that actually makes sense for everyday people, not hedge fund managers. Let's permanently bust a massive Wall Street myth right now. The financial industry matrix desperately wants you to believe that successful investing requires daily trading, advanced quantitative algorithms, and tens of thousands of dollars just to open an account. That is a complete and utter lie designed to collect management fees from you. According to the prestigious Spiva report, over 85% of highly paid active fund managers actually underperform the basic market average over 10 years. If the pros can't do it, how much money do you actually need for passive investing? You can start right now with just a single $50 bill. But how do you actually turn this $50 into a diversified wealth-building machine? First, we tackle the platform problem. Sam searches for the best platforms for passive investing beginners and opens an account with Vanguard. Notice the interface? It's clean. There are no flashing red lights, no gamified confetti to trigger dopamine hits, no anxiety, just steady wealth building. Are index funds considered passive investing? Absolutely. Think of a broad S&P 500 ETF like VOO. By buying just one fractional share for $50, Sam instantly diversifies his money across the 500 largest, most profitable companies in America, from Apple to Amazon. If one company fails, the other 499 carry the weight. This is exactly how to invest passively. You aren't picking winners, you are betting on the entire American economy.
He's finally building the machine.
If you're having your own light bulb moment right now, hit subscribe to join the community. Now, let's talk about the ultimate psychological superpower: how to automate your passive investments. Sam securely links his bank account and sets up a $50 monthly recurring transfer. Because it's automated, he removes human willpower and emotion from the equation entirely. He has officially figured out how to invest in index funds for passive income. He can finally relax. But the very next morning, a macroeconomic disaster strikes. Due to unexpected global inflation data, the stock market plummets 3% in a single trading session. Sam's brand new, carefully crafted portfolio is instantly bleeding red. His phone is blowing up with catastrophic news alerts. His finger hovers nervously, shaking over the bright red sell button. Time slows down to a crawl. Will his loss aversion trigger? Does he panic, sell at a massive loss, and destroy his early retirement dream forever?
Every single human evolutionary instinct is screaming at Sam to hit sell and run for the hills. Unpredictable market volatility is the absolute biggest risk of passive investing. But in this dark, gut-wrenching moment, he remembers the core, unshakable rule of this strategy. When the market drops, do absolutely nothing. Sam puts the phone entirely out of sight, walks out his front door, and steps outside into a vibrant park to literally touch grass. He realizes something profound. In the world of long-term investing, doing nothing is actually an incredibly powerful, deliberate action. Patience is a weapon. Fast forward 10 years into the future. By stubbornly sticking to his automated deposits through multiple market crashes, Sam's wealth has quietly compounded at the historical 10% average.
Let's quickly recap Sam's actionable steps so you can copy his homework today. First, ignore active trading hype. 85% of Wall Street pros fail to beat the market. Second, choose a clean, simple, low-fee platform like Vanguard. Third, start small with fractional shares, using as little as $50. Fourth, buy a broad market index fund like the S&P 500 to own the entire Haystack. Fifth, automate your monthly contributions to remove your emotional impulses. And sixth, when the market drops, detach emotionally. Leave your portfolio alone and go touch grass. This breakdown proves mathematically that time in the market will always beat trying to time the market. What is your absolute biggest psychological fear about getting started with investing today? Drop it in the comments below right now. Sam conquered his deepest financial fears by mastering this set and forget system, and you can build a hands-off, wealth-generating portfolio too. Real wealth isn't about buying yachts. It's about buying back your time. If having passive investing explained through Sam's 2026 journey provided you with clarity today, hit that like button, subscribe to the channel, and share this video with a friend who has a busy brain and needs to automate their finances. But wait, mastering index funds is only step one of your financial journey. Next week, we're exploring the ultimate dividend growth strategy to generate actual usable cash flow while you sleep. Click the video on your screen right now to keep learning and keep the compound interest rolling. Start your journey today, and remember, sometimes doing absolutely nothing is the single greatest thing you can do for your future.